I've learned a hard truth over many years in the market, a truth most investors grasp only after significant losses. Dividends are not created equal. When the market's soaring and portfolios swell, dividends seem almost irrelevant. But a crash always comes, and that's when you discover which dividends survive and which vanish. I've lived through 14 major market crashes, and I've seen seemingly invincible companies slash their dividends overnight. I bought my first stock in 1942 in the middle of World War II when the future was far from certain. I've watched retirees who built their entire income strategy around dividend payments wake up to find their monthly checks cut in half or gone completely. But I've also witnessed a select few companies continue paying, even increasing their dividends through the worst economic disasters in modern history. Today, I want to share with you what I believe are the only 4 dividend stocks that will not just survive the next crash, but actually thrive through it. These are companies that have proven through multiple recessions, wars, financial crises, and even pandemics that their dividends are sacred. Their management understands that the dividend is not just a bonus, but a fundamental commitment. Before I reveal these companies, I need to tell you a story that changed how I think about dividends forever. If you don't understand why certain dividends survive crashes while others don't, you'll repeat the mistakes that have cost millions their retirement security. It was 1973. The stock market was about to enter one of the worst bear markets since the Great Depression. Over the next 2 years, stocks would fall nearly 50%. Inflation was raging, oil prices were spiking, and the economy was entering stagflation, that toxic mix of high inflation and economic stagnation that destroys wealth from both directions. I remember talking to a friend who had retired the year before. He had built what he thought was a bulletproof dividend portfolio, blue chip companies, household names, stocks that had paid dividends for decades. He was counting on that dividend income to fund his retirement, to pay his bills, and to maintain his lifestyle without touching his principal. Within 18 months, more than half of those companies had cut their dividends, some eliminating them entirely. His monthly income dropped from $4,000 to less than $2,000. He had to go back to work at 67 years old because he had chosen the wrong dividend stocks. That experience taught me something I've never forgotten. Not all dividends are created equal. Some dividends are promises made when times are good, but broken when times get tough. Other dividends are sacred commitments backed by business models so strong, so essential, and so profitable that the company can maintain them through anything. The question is, how do you tell the difference before the crash, not after? After decades of studying this, I've identified 4 characteristics that separate crash-proof dividends from those that disappear. Every single one of the 4 stocks I'm about to share with you possesses all 4 of these characteristics. Understanding these characteristics is just as important as knowing the specific companies because it will help you evaluate any dividend stock you consider in the future. The first characteristic is essential products or services. A company cannot maintain its dividend through a crash if its revenue disappears during hard times. When the economy contracts, consumers and businesses cut spending. The first things they cut are discretionary purchases, the nice-to-haves, the luxuries, the things they can live without. But certain products and services cannot be cut, no matter how bad the economy gets. People still need electricity, medicine. They still need to brush their teeth, wash their clothes, and buy groceries. Companies that provide these essential products have revenue that is recession resistant, and recession resistant revenue supports recession resistant dividends. The second characteristic is pricing power. it's not enough to sell essential products. You also need the ability to raise prices when your costs increase. During inflationary periods, companies face higher costs for labor, raw materials, transportation, everything. If they cannot pass those costs on to customers through higher prices, their profit margins get squeezed. Squeezed margins mean less cash available for dividends. But companies with strong brands, with products that have no substitutes, with services customers cannot easily replace, these companies can raise prices without losing customers. That pricing power protects their margins and their dividends even during the worst economic conditions. The third characteristic is a fortress balance sheet. Debt kills dividends. When a company has too much debt, when interest payments consume a large portion of their cash flow, the dividend becomes vulnerable. During a crisis, lenders get paid first. Interest payments are mandatory, dividends are discretionary. If cash flow falls and debt payments stay the same, the dividend gets cut. But companies with low debt, with strong cash positions, with investment-grade credit ratings, these companies have the financial flexibility to maintain dividends even when revenue temporarily declines. They don't have to choose between paying their lenders and paying their shareholders. The fourth characteristic is a long track record of dividend growth. Past behavior is the best predictor of future behavior. I've always found something deeply comforting about companies that just keep doing what they do year after year. Companies that don't chase trends, but instead focus on providing essential goods and services. It's in that spirit that I want to talk about dividend stocks, the kind I believe will weather any storm, because the best predictor of future behavior, especially when it comes to dividends, is past behavior. A company that has consistently paid and even increased its dividend for 25, 50, or even 100 years has proven its commitment through multiple recessions. It shows that those dividend payments are a core promise, not just an optional extra. These companies build their entire culture around the dividend, knowing that cutting it would be seen as a failure, a betrayal of shareholders who have placed their trust in them for generations. It's a cultural commitment that newer dividend payers simply can't match. I want to share a few dividend stocks that, in my opinion, possess these characteristics, the kinds of dividends that I think will survive the next crash, whenever that may be. The first one is Johnson & Johnson. Now, I know what some of you might be thinking. Everyone knows Johnson & Johnson. It's not some exciting new discovery, and you're right. That's precisely the point. The best dividend stocks aren't exciting. They're predictable. They do the same thing year after year, decade after decade, reliably generating profits and returning those profits to shareholders. Let me tell you why Johnson & Johnson has what I consider to be one of the most crash-proof dividends in the entire stock market. First, consider what they sell: healthcare products, pharmaceuticals, medical devices, and consumer health products like Band-Aids, Tylenol, and Listerine. These aren't discretionary purchases. When you have a headache, you buy Tylenol. When a child scrapes their knee, you reach for a Band-Aid. When you need heart surgery, you don't decide to skip it because the economy is in a recession. Healthcare spending is one of the most recession-resistant sectors of the entire economy. During the 2008 financial crisis, when unemployment spiked and consumer spending collapsed, healthcare spending actually increased. People cut back on vacations, restaurants, and new cars, but not on their medications and medical treatments. Second, Johnson & Johnson has extraordinary pricing power. Their pharmaceutical products are protected by patents, and their consumer brands have been trusted for over a century. When Johnson & Johnson raises prices, customers don't switch to competitors because often there aren't direct competitors with the same level of trust and quality. This pricing power has allowed them to maintain healthy profit margins through every economic environment. Third, their balance sheet is one of the strongest in corporate America. Johnson & Johnson is one of only 2 companies in the United States with a AAA credit rating from the major rating agencies higher than the credit rating of the United States government. They have more cash than debt and generate over $20 billion in free cash flow every year. They could pay their dividend for years, even if they never made another sale. That's financial strength that provides enormous protection during a crisis. And fourth, their dividend track record is extraordinary. Johnson & Johnson has increased its dividend for 62 consecutive years. That means they've raised their dividend every single year since 1962, through the oil crisis of the 1970s, through stagflation, through the 1987 crash, through the dot-com bubble, through the 2008 financial crisis, and through the pandemic. Every single year, the dividend went up. That's not luck. That's a corporate culture built around the dividend as a sacred commitment to shareholders. Now, some investors worry about the litigation risks that Johnson & Johnson faces with lawsuits related to talc products and other issues. These are legitimate concerns, but those investors might be missing something important. Johnson & Johnson has faced litigation throughout its history. Lawsuits are a cost of doing business in healthcare. And through all of that litigation, they've never cut their dividend, not once in 62 years. They have the financial resources to handle legal challenges while still rewarding shareholders. That, to me, is the definition of a crash-proof dividend. The second stock I want to mention is Procter & Gamble. This is another company that some might consider boring, and once again, that's exactly the point. Procter & Gamble sells products that you use every single day without even thinking about it. Tide laundry detergent, Crest toothpaste, Gillette razors, Pampers diapers, Charmin toilet paper, Bounty paper towels, Head & Shoulders shampoo. These aren't luxury goods, they're necessities. When the economy enters a recession, people don't stop washing their clothes, brushing their teeth, or buying diapers for their babies. Let me walk you through why Procter & Gamble's dividend is so secure. Their products are essential to daily life, creating what I call recession-resistant demand. During the 2008 crisis, Procter & Gamble's sales barely declined. People traded down from restaurants to home cooking, but they still needed dish soap. They skipped vacations but still bought toothpaste. The essential nature of their products provides a floor under their revenue that most companies simply don't have. Their brands command premium pricing. Consumers pay more for Tide than generic laundry detergent because they trust that Tide will get their clothes clean. They pay more for Gillette razors because they trust the quality. This brand premium gives Procter & Gamble pricing power that protects their margins during inflationary periods. When their costs go up, they raise prices and customers keep buying because they trust the brands. Their balance sheet is rock solid. They carry manageable debt levels and generate enormous free cash flow, over $15 billion annually. This cash flow provides more than enough cushion to maintain and grow the dividend even if business conditions temporarily deteriorate. And their dividend history is remarkable. Procter & Gamble has paid a dividend every year since 1890. The power of dividend growth compounding over time, I've seen it firsthand. I've held Coca-Cola stock since 1988, and I've never sold a single share. The dividend income I get from Coca-Cola today actually exceeds my entire original investment. Beyond my personal history, Coca-Cola possesses all the characteristics of a crash-proof dividend in abundance. Consider the essential nature of their products. You might argue that soda isn't essential like medicine or electricity, and technically you'd be right. But Coca-Cola doesn't just sell soda anymore. They own water brands, juice brands, tea and coffee brands, sports drinks, and energy drinks. They've diversified into virtually every beverage category, and beverages are remarkably recession resistant. People might skip the expensive dinner, but they'll still buy drinks at the grocery store. More importantly, Coca-Cola has something even more valuable than essential products. They have an emotional connection with consumers that transcends logic. People don't drink Coca-Cola because it's the cheapest or healthiest option. They drink it because it makes them feel something. That emotional connection creates loyalty that survives economic downturns. When people are stressed and worried, a Coca-Cola can be a small, affordable treat that makes them feel better. It might sound trivial, but it's worth billions in recession-resistant revenue. Coca-Cola's pricing power is legendary. They've raised prices consistently for decades, and consumers keep buying. Their brand is so strong, globally recognized, and trusted that they can charge premium prices. During the recent inflationary period, Coca-Cola raised prices significantly, and their sales volumes held steady. That pricing power protects their margins and their ability to pay dividends. Their balance sheet is strong. They generate reliable free cash flow year after year, have manageable debt levels and strong credit ratings. They've demonstrated time and again that they can maintain their dividend through challenging conditions. Coca-Cola has increased its dividend for 62 consecutive years. Just like Johnson & Johnson, they've raised their dividend every single year for over 6 decades through every economic environment imaginable. The dividend is sacred at Coca-Cola. Management knows that shareholders depend on that income and that cutting the dividend would be an unforgivable breach of trust. Something else I love about Coca-Cola as a crash-proof dividend stock, their business is incredibly simple to understand. They make beverages, distribute them, and market them. There are no complex financial instruments, incomprehensible business models, or black boxes that hide risk. When the financial crisis hit in 2008 and investors discovered that many financial companies owned toxic assets nobody understood, Coca-Cola kept doing exactly what they had always done, making drinks, selling drinks, paying dividends. Simplicity is underrated as a form of safety. The fourth and final stock is Walmart. Some investors look down on Walmart, seeing it as a low-end retailer, not as prestigious as other blue-chip companies. But that snobbery blinds them to the crash-proof nature of Walmart's dividend. Here's the truth about recessions. When the economy contracts, when people lose their jobs, when families have to tighten their budgets, they don't stop buying groceries and household essentials. They just buy them at cheaper stores, and there's no cheaper store than Walmart. During the 2008 financial crisis, while most retailers saw their sales collapse, Walmart sales actually increased. Consumers who previously shopped at more expensive stores traded down to Walmart to stretch their budgets further. This is the ultimate recession-resistant business model. Walmart doesn't just survive recessions, they benefit from them. When times get hard, more people shop at Walmart, not fewer. Walmart sells essential products, food, medicine, household supplies, clothing. These are things people need regardless of economic conditions. They might buy fewer televisions and toys during a recession, but they won't stop buying groceries. Groceries now account for more than half of Walmart sales. They're essentially the largest grocer in America, and groceries are about as recession-proof as any product category can be. Walmart's pricing power is unique. They're not the premium player who can charge more than competitors. Instead, they're the low-cost leader who forces competitors to match their prices. This might seem like a disadvantage, but I find myself thinking about how certain companies seem to thrive even when the world feels like it's falling apart. Take Walmart, for instance. It's fascinating how they actually gain strength during inflationary periods. When prices rise, people naturally become more careful with their money, and that search for the lowest prices often leads them straight to Walmart. During the recent inflationary period, I saw how Walmart gained market share as budget-conscious consumers flocked to their stores. Their financial position is incredibly strong. They generate over $20 billion in free cash flow each year and hold investment-grade credit ratings. This gives them the resources to maintain their dividend regardless of the economic climate, and their sheer size grants them enormous negotiating power with suppliers, which helps protect their profit margins even when their costs increase. I've always been impressed by Walmart's dividend track record. They've increased their dividend for 51 consecutive years, which makes them a dividend king. They've maintained that streak through multiple recessions, including the 2008 financial crisis and the pandemic. The dividend is clearly a priority for Walmart, and their business model allows them to honor that priority no matter what the economic conditions are. Now, stepping back, I want to consider how these four stocks, Johnson & Johnson, Procter & Gamble, Coca-Cola, and Walmart, work together as a crash-proof dividend portfolio. The power isn't just in the individual companies, it's in how they complement each other. Johnson & Johnson provides expo to healthcare, one of the most recession-resistant sectors. Procter & Gamble and Coca-Cola offer expo to consumer staples, the daily necessities people buy no matter what. And Walmart provides expo to a business model that actually benefits from recessions. Together, these four companies offer diversification across different sectors while maintaining recession-resistant revenue, pricing power, strong balance sheets, and long dividend track records. If one sector faces challenges, the others provide stability, and most importantly, all four sectors tend to perform relatively well during economic downturns. I've seen what happens when you own these stocks during a crash. First, your dividend income keeps flowing. While other investors watch their dividend payments get cut, your checks keep coming. That income provides stability when everything else feels chaotic. It gives you options. You can reinvest those dividends at lower prices, buying more shares when stocks are cheap, or you can use that income to cover living expenses without selling shares at depressed prices. Second, these stocks tend to decline less than the overall market during crashes. They're not immune to price declines. All stocks go down during bear markets, but defensive dividend payers like these tend to fall less because investors flee from risky assets and seek safety in stable income-producing stocks. So not only does your income continue, but your portfolio value is more protected. Third, these stocks tend to recover faster than speculative investments. When the market rebounds, quality dividend payers lead the way. They have real earnings, real cash flows, real dividends. They don't need a speculative bubble to justify their valuation. While investors who own risky stocks might wait years for recovery, dividend stock investors often get back to even much faster. I know some of you might be wondering about the dividend yields on these stocks. They range from about 2% to about 3% currently, which might not seem exciting compared to higher yielding options. Why would you accept 3% when some stocks offer 6%, 8%, or even 10% yields? High dividend yields are often a warning sign, not an opportunity. When a stock has an unusually high yield, it usually means one of two things. Either the stock price has collapsed because investors expect the dividend to be cut, or the company is paying out more than it can sustainably afford, which means a dividend cut is coming. Either way, that high yield is an illusion. You might collect a few high payments, but eventually the dividend gets cut and the stock price falls further. The stocks I've shared with you today have modest yields, but those yields are sustainable and growing. Johnson & Johnson has raised its dividend every year for 62 years, Procter & Gamble for 68 years, Coca-Cola for 62 years, and Walmart for 51 years. If you buy these stocks and hold them, your yield on your original investment grows every year. That 3% yield today becomes 5% in 10 years and 8% in 20 years as the dividend keeps increasing. That's the true path to retirement income security. Not chasing the highest yield today, but owning dividends that grow over time and survive every crash along the way. The biggest mistake I see dividend investors make is reaching for yield. When investors need income, they naturally gravitate toward whatever pays the highest percentage. If one stock yields 3% and another yields 8%, the 8% seems obviously better, but that 8% yield often comes from a struggling company in a difficult industry with a dividend that is about to be cut. I've watched countless investors make this mistake. They buy a high-yield stock, collect a few dividend payments, and then the company announces a dividend cut. The stock price crashes, the dividend payment drops, and the investor has lost far more than they ever earned from those high-yield payments. They would have been much better off with the boring 3% yield that keeps growing year after year. The 4 stocks I've mentioned today are not the highest yielding options available, but they are among the most reliable, and reliability is what you need when a crash comes. You don't need excitement. You don't need the highest possible yield. You need income you can count on. Let me share some final thoughts about positioning your portfolio for the next crash. The next market crash is inevitable. I've lived long enough and studied enough market history to know that with certainty. The real question isn't whether a crash will happen, but whether your portfolio is ready to weather the storm. It's not enough to just know which stocks to own. You also need to consider how to own them. I believe in building positions gradually rather than all at once. After all, none of us truly knows when the next downturn will strike. If you invest everything today and the market crashes tomorrow, you'll feel it, even if you hold the right stocks. But by building positions gradually over time, you naturally buy more shares when prices are low and fewer when they're high. This dollar cost averaging, as it's called, reduces risk and, in my experience, improves long-term results. Another thing I've learned is to reinvest dividends automatically, at least while you're still building your portfolio. Each dividend payment buys more shares. Those shares generate more dividends, and those dividends buy even more shares. The compounding effect is extraordinarily powerful over long periods. 20 years of reinvested dividends can double or triple your share count without you adding another dollar. Resisting the urge to sell during a crash is perhaps the hardest part. When markets plunge, when the news is terrifying, when it feels like the world is ending, every instinct screams to sell and protect what's left. But selling during a crash locks in losses and eliminates the chance to participate in the recovery. If you own resilient dividend stocks, you simply don't need to sell. The dividends keep coming, the companies keep operating, and the stock prices eventually recover. You just need to wait. It's important to understand that these aren't get-rich-quick investments. They're wealth preservation investments, retirement income investments, get-rich-slowly investments. If you're looking for stocks that might double or triple in a year, these aren't them. But if you want stocks that will still be paying you growing dividends 20 years from now, regardless of the economic climate, these are exactly those stocks. If you own companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, and Walmart, your dividend income will continue to flow through the crash. your portfolio will decline less than more speculative investments, and you will recover faster when the storm passes. In my opinion, that's the closest thing to crash proof that exists in the stock market. Don't chase excitement. Don't reach for yield. Don't try to time the market.